The world of global politics is often a theater of grand gestures and loud pronouncements. Yet sometimes the biggest moves happen quietly through a single direct connection. The recent phone call between Xi Jinping and Donald Trump. He is now a formidable political figure again. The call wasn't from a sitting head of state, but its implications reverberate like one. This conversation signals a potential shift in the trajectory of the planet's most consequential bilateral relationship, especially around international trade. The fact the call happened is a geopolitical event. Direct talks at that level are never accidental. It's a calculated move to send messages to each other, to domestic audiences, and to global markets. To understand the potential impact, one must first grasp the current state of U.S.-China trade ties. Today, on November 25, 2025, the relationship is a patchwork of lingering tariffs, targeted sanctions, strategic competition over key technologies, semiconductors, artificial intelligence. While total trade volume remains substantial, its character has changed. Companies have spent years attempting to de-risk their operations, diversifying supply chains away from China, friendshoring, nearshoring. This has created a more fragmented and expensive global manufacturing system, with costs often passed down to consumers. Higher prices for everyday goods. The phone call could represent a critical inflection point, a chance to recalibrate this delicate economic balance. The first and most direct effect would be on tariffs and trade rules. A positive outcome from the Xi-Trump dialogue could kick off de-escalation. Imagine a mutual agreement to suspend part of the existing tariffs, announced as a 6-month trial. That would immediately lower costs for businesses on both sides. An American importer of electronic components from China might see costs fall 15 to 25%. That lets the company either increase profit margins or lower customer prices. Last year, U.S. imports from China still topped $400 billion, even with tariffs. The second major effect is on global supply chains and manufacturing footprints. For years, the dominant story has been decoupling. A political thaw could slow that trend or even partially reverse it. Financial markets hate uncertainty. Even a hint of constructive dialogue can spark optimism, rising stock indices and steadier currency markets. Stocks of companies exposed to China could rally. Semiconductor firms, automotive giants, major retailers. That confidence filters into corporate investment. Conversely, a negative read could freeze investment and spook markets. One of the most hopeful outcomes stemming from this phone call is the establishment of a formal recurring dialogue aimed at resolving trade disputes. Instead of sudden tariff announcements, the two sides could agree to create a joint working group. This body would meet quarterly to address specific issues: intellectual property protection, market access for financial services. A tangible success might involve China agreeing to new, verifiable enforcement mechanisms for patent infringement, while the U.S. agrees to ease restrictions on certain non-sensitive exports. That would be a move toward a more mature, predictable relationship, building a foundation of trust one small agreement at a time, helping businesses plan for the future with greater clarity. However, a significant risk looms: the potential for the call to be nothing more than political posturing. The friendly words could be a temporary tactic intended to calm markets or to score domestic political points without genuine commitment. Deep-seated strategic rivalries, especially in national security and technological supremacy, may prove insurmountable obstacles. A disagreement over Taiwan or continued friction in the South China Sea could easily derail progress on trade. In that case, the brief moment of hope would quickly dissipate, leaving cynicism and distrust. The greatest danger is that expectations are raised only to be dashed. In conclusion, the phone call between Xi Jinping and Donald Trump is a pivotal moment, a small gesture with the potential to move global markets and reshape international trade. Its ultimate significance will not be determined by the initial headlines, but by the concrete actions that follow. The conversation has opened a door that had been firmly shut, presenting an opportunity to steer the US-China economic relationship away from a path of escalating confrontation and toward a model of managed competition. The difference between these two futures is immense, affecting everything from the price of groceries to the strategic decisions of the world's largest companies. This is not just a story about politics. It is about the real-world economic conditions for billions of people. The three primary effects to monitor will be changes in tariff structures, shifts in global supply chain strategies resulting fluctuations in business and market confidence. A reduction in tariffs would provide immediate economic relief, while a more stable policy environment would allow companies to make long-term investments with greater certainty. However, these potential gains are balanced by the considerable risk that the dialogue will not translate into meaningful policy changes, leaving the global economy in the same precarious position it was in before. The weight of past disputes and ongoing strategic competition remains a powerful gravitational force pulling the two nations apart. For now, careful observation and prudent preparation remain the wisest course for all.